Okay, so we discussed how to adjust the formula for BCVA under netting as well as under collateral. As briefly pointed out, yes, so typically see the threshold and initial margin are driven by opposite intentions. So doesn't make sense to have both threshold and initial margin at the same time. So typically you will see if there is an initial margin or as we call it, independent collateral amount, ICA, threshold would be 0. Because you see, when you are saying that I have a threshold, that means I am willing to tolerate you to some extent. But if I'm saying give security margin, that means I'm not trusting you, right? I'm not willing to tolerate. So those are two counterintuitive requirements. So if you're asking for initial margin, that means you are worried about the safety or the counterparty credit risk at the beginning. So your tolerance should be 0, threshold should be 0, right? If you have threshold, then it doesn't make sense to have initial margin. That is there, but just to in case. So this is in general the construct. Okay, all right. Let's proceed. So what is our story so far? Our story so far is this: fair value of the derivative is the risk-free or risk-neutral valuation minus BCVA. If you do minus BCVA, then the CVA term would be a minus and the DVA term would actually be a plus because you see here the this is a negative exposure component. So if you see, we have ENE, this by definition is negative. So when you take a minus, minus, minus becomes plus. So that's how it is positive. Question, is there any difference between independent amount and initial margin? So initial margin is actually for the exchange traded derivatives. So they demand huge initial margin. Independent collateral amount is something that is more colloquial or applicable to OTC derivatives, but today they are used interchangeably. So yeah, you can use interchangeably. All right, story so far is this. Now, DVA was controversial. Definitely the intention was to bring in some kind of price symmetry so that both counterparties will come to the same price. But price symmetry remains as a pipe dream because even if they capture the components together, some underlying assumptions could be very, very different for the bank and for the counterparty. Okay, the modeling assumptions are always different between two different entities. So the way the bank calculates CVA part and the way the counterparty calculates the DVA part, or vice versa, there would be different assumptions, right? So this price symmetry, that was the ambition. In practice, what was actually never achieved. Okay, so it worked in theory, but in practice, this remains as a pipeline. So what happened after this? Well, not after this, after the global financial crisis. So we'll discuss now FVA, which stands for Funding Valuation Adjustment. Now, what happened during the meltdown is, before the 2008 crisis, pretty much everybody had one rate curve per currency, and that was the one used for risk neutral pricing, discounting, everything. Okay, we never thought of different term structures within one currency. It was not needed. The reason is interest rates were considered virtually risk-free. Okay, interest rates, any kind of interest rate was considered virtually risk-free. They were very, very close to each other, very similar. So pretty much everybody used the IBOR rates. Back then it was obviously LIBOR. Everybody used LIBOR 3-month as a proxy for interest rate derivative valuation. Also the same LIBOR rate curve for discounting. But during the crisis, the spread between the overnight index swap rate and the LIBOR skyrocketed. I think it reached somewhere around 360 basis points or something. So then everybody realized, hey, these curves are actually different. LIBOR is not risk-free. OIS is a better proxy for risk-free because it is, overnight index rate. So there was a huge spread between these two. So then people realized, well, we cannot simply assume that all interest rates are driven by a single curve. We need to have different curves. Every bank's funding curve is different. Okay, every bank's funding curve is different. So what people realized at that time is OIS rate makes sense for secure transactions because it is a good proxy for risk-free. But for unsecured transactions, probably every bank needs to use their own funding rate curve. Now, depending on your rating, you have a different funding curve, right? It could be very different. So there the concept of multi-curve framework originated. It is currently a chaos. We will discuss in detail in the course, but this is just introduction. So this gave rise to the idea of funding valuation adjustment because we are using every bank and every counterparty have their different funding curves. So for them to agree on the derivative and all the collateral requirement that goes along with it, it gives rise to different funding costs. We'll see the calculation. So everybody thought, let's add this cost to the pricing of the derivative. Remember, the inspiration behind xVA is its derivative is like a manufacturing process. You start with the base raw price. Then you add on different fees, staff fees, management fees, computer cost, all those potential cost and benefits that you can think of, right? You keep doing those adjustments. So FVA is driven from the funding differences in funding costs. All right. So let's see how the calculation is there. Before we go to the calculation, two fundamental ideas. If you have a positive exposure, that means counterparty owes you money, you have positive exposure, it's an asset for you. I mean, you have that money, but the problem is you are not able to utilize that money. So we are talking about uncollateralized exposure, unsecured derivative, okay? There is no collateral transfer. So if you are winning, counterparty owes you money, it's an asset, but you don't have that, right? So every asset has a funding cost associated with it. So idea is to fund a particular asset, you have to borrow that fund and then invest in an asset. Asset should give you more revenue, a higher rate of return, and then you pocket the profit. That's the whole idea. But here you have an asset, but you're not able to utilize that. So it's kind of like a lost opportunity cost. You can think like that. Asset is associated with a funding cost, right? Think of the other scenario. If you have a negative exposure, that means you owe money to the counterparty, then it's a liability because you owe the money, but then you are enjoying that funding because you are not paying any interest or anything. You owe you have taken a loan, but you are not paying any interest. So you are enjoying the funding benefit. Okay, so this is the main idea. Actually, there are multiple arguments behind FVA. I think this is the simplest one, right? If you have an asset, it has a funding cost. Every asset needs to be supported by a funding cost. This is the borrowing cost. And then if you have free money with you, you owe it, but you don't have to give it because it is until the end of maturity, you can keep it with you. So it's associated with a funding benefit. Similarly, when you get collateral from the counterparty, that also gives funding benefit in various ways. Variation margin, for example, is the collateral that gives you funding benefit because you can rehypothecate that collateral. You can use that collateral in some other transaction. But the initial margin does not give you funding benefit because you cannot use initial margin. It will be opened only when somebody defaults. Okay, it is called segregated. So you cannot use that. So this is the idea. Now let's look at the calculation. So let's say that you have this exposure, VT. XT is the amount of collateral you already have. This is the collateral held right now. The unsecured portion is this, VT minus XT. This is the uncollateralized or residual exposure. Okay. Now for that residual exposure, you will have some funding cost. to calculate the funding cost, let's understand this. So let's say you have this much of residual exposure. Okay, there are various arguments that lead to the same formula. The one that I find convenient is yeah. So let's discuss this. So let's say you have this much of residual exposure. Okay, now you want to hedge that. You want to, as a bank, you don't want this risk. You want to hedge this much in the market. Now, in the market, when you want to hedge this much, let's say that has full CSA. That means you have to, that is a collateralized transaction. Okay. So you'll take the opposite position in the derivative for this much of exposure. You'll take the opposite position. If you take the opposite position, here you are in the money. In the hedging transaction, you will be out of the money. So you will be owing the money to the counterparty. Correct? If you owe the money, then you have to transfer collateral. How much? This much of collateral you have to post in the hedged transaction. Correct? Now, in order to post collateral, you have to borrow it. Right? You have to borrow it. To borrow the collateral, you, based on your funding rate, at that rate, you will be able to borrow the collateral. You will borrow the collateral at your funding rate for this much amount that you want to hedge. Post it in the other transaction, hedge derivative. But the collateral that you post, you actually earn some remuneration also, right? So when you post collateral, you earn some, I mean, this is also debatable. Let's call it collateral rate. Typically, it is OIS rate that you earn, but let's call it RX. So the rate that you earn on collateral. So basically, when you post the collateral, you earn this RX rate, and your funding rate is RF. You have to borrow that collateral at funding rate and post it, right? The spread is this difference, RF minus RX. Now, this is your loss. This is your loss. You are able to earn this much from your collateral that you posted, but your borrowing rate is RF. So the difference is what you are incurring as a cost. I hope now it makes sense. Right? So yeah, you can get into the opposite trade to hedge the residual exposure. Your borrowing rate is RF, but you get a remuneration of RX. So your funding cost is RF minus RX. Now, this rate would be applicable for what amount of exposure? This amount of exposure, the residual exposure, which is the uncollateralized exposure, correct? Because that is that much you need to hedge. And we normally, if you see literature in FBA, they call it that it arises from hedging error. This portion we couldn't hedge, so it's a hedging error. Okay, so funding cost adjustment is, look at the nature of the formula. It's the same pattern everywhere. Let's talk about each and every component. First of all, you need to have a positive exposure. Remember, FCA, funding cost adjustment. So FVA has two parts to it: funding cost adjustment and funding benefit adjustment. Funding cost adjustment applies to a situation where you have positive residual exposure. You have an asset, right? You are not able to use it. So this is a hedging argument that we use to calculate this expression. There are other ways to do this, but I think this is the simplest. Now, residual exposure is positive, right? On that, you incur a funding spread cost because you are earning something and you are borrowing at a different rate. The differential is the net cost. So that's the expression. Now, this expression makes sense only when both of you survive. See, there is no lambda here. It's e to the power minus lambda c t, e to the power minus lambda b t. That means this part is the joint probability of survival of both of you. Both bank and counterparty have to survive for this expression to make sense. This is not related to default. This is related to the recurring cost that you incur as long as you have a positive exposure to the counterparty. Positive unsecured exposure. Okay. Hope this makes sense. Right? Same pattern is there. Now, yeah, as I mentioned, this part is the probability that both parties survive, jointly survive. and discounted positive residual exposure. That makes sense. Now, the funding spread, which is, pretend this is the OIS rate, okay? Yes, Abhishek has the right question. Does funding spread considers the credit spread? It is closely related. For all intents and purposes, it can be considered as the credit spread. Close proxy, because what is credit spread? Credit spread is your sort of borrowing rate over and above the risk-free rate, isn't it? So that is exactly what we have here. There are some differences, yes, but right now let's keep things simple. There are a lot of practical small issues. So the funding spread can be written as the hazard rate times the LGD. This is what we saw. Remember, lambda is spread divided by LGD. So spread is LGD times lambda. Okay. So we have this beautiful expression for FCA. This is applicable for specific cases. But pretty much, yeah, this is what the expression is. Krishna has a question. The joint survival probability assumes independence. Yes, totally, because it's a product. Since we are doing a product, it assumes independence. If they are related, then you have to use some kind of copula model. If they are not independent, then you have to jointly model the default product using some copula. Yeah. This is FCA, okay? The reverse argument I can do for the liability position, where you owe the money to the counterparty, correct? Then you enjoy a benefit because, exact same opposite, think like that. Funding benefit adjustment, everything remains the same. Only here, I take the negative exposure. Only when you have a negative exposure, you enjoy the funding benefit. Everything remains the same. But if you look at this very closely, this one is same as, who can tell me? We have seen this expression before. The second one, FBA. This is DVA, guys. For DVA, we have the same expression. That's why this created controversy. Okay, so let's see what practitioners had to say with this. When people came up with the idea of FVA to include or reflect their own funding cost and benefits, first and foremost, Hull and White vehemently opposed this idea. So there, if you look at their recommendation, it was basically they said, do not bring all these valuation adjustments to the risk neutral derivative pricing. It defeats the elegance and the system of pricing. Keep these personally to yourself, but do not add all these valuation adjustments. Derivative pricing in principle is based on risk neutral pricing. Keep it as is. Do not contaminate with all these FBA ideas. So they oppose this. Okay. Also, as we saw, FBA and DVA together lead to double counting. So we do not use both. But there are differences. As Bhuvan mentioned, if there are difference in basis, then we need to take care of both. But this was another argument that it leads to double counting. Okay. Today, do we have, it is still controversial, right? To some extent, but largely speaking, today everybody has adopted FVA. They are using it pretty much. Okay, now if you look at FBA and FCA, FCA has to do with positive exposure. FBA has to do with negative exposure. But if you want to make it a symmetric formulation, that means FBA plus FCA. So either you will enjoy the, incur the cost or enjoy the benefit, not both, right? Depending on whether your exposure is positive or negative. Put those expressions together, that's called as FVA, which is FBA plus FCA. And the plus or minus goes away. It's just, now it becomes a signed value. That means it can be both positive or negative, depending on which one is larger. Right? So in one formula, you can calculate FVA. You don't need to calculate FCA, FBA independently. You can calculate in one shot. Depending on whether this is positive or negative, it will provide you the benefit or cost. All right. So that's FVA in a nutshell. So our story so far is this: risk neutral valuation minus CVA. I removed the BCVA because DVA and FBA are kind of duplicating each other. So I just kept the CVA as is, and then minus FVA. All right. The last, no, not the last one. There is one more after this. Now the floodgates of valuation adjustment just opened up. Right? People came up with all kinds of potential cost and benefits and started putting it into the pricing equation. The next one we'll look at is collateral valuation adjustment and margin valuation adjustment. They are related because they both are specific to the collateral. colVA is in general. MVA, which is the margin valuation adjustment, that is specific to the initial margin that you post to the counterparty. Again, this is complicated in practice, but let's see at a theoretical standpoint how these are calculated. As we discussed, there are two types of collaterals. One is variation margin, XT, and one is initial margin or independent collateral amount, IT. colVA arises due to differences in. So see, the valuation adjustments are basically, they arise because of differences in borrowing and lending. What you earn and what is your borrowing cost, because of the spread between these two, there is adjustment. That's the general principle. Okay. With this collateral exchange, right, the same idea applies. There is a rate at which you'll borrow the collateral and post. And when you post, you get some remuneration out of it. What is the differential? And you incur the cost benefit. Now, when we talked about FVA, it was on the residual exposure. FVA has to do with the residual exposure. So taking the effect of collateral out of the exposure, whatever is remaining on that part, you incur cost or benefit. This one is specific to the collateral that was received or posted. Specific to the collateral, not the residual exposure. These are different. Okay. So say I is the initial margin that you posted, and I tilde is the initial margin that you received from the counterparty. R is the risk-free rate. Rx is the rate on the variation margin, which is X. So this is the spread over the risk-free rate, collateral spread for the variation margin. Similarly, you have a spread on the initial margin. Okay. This is the spread on the initial margin. I is the one that you posted. So this is what you earn and this is what you borrow to get the initial margin and then post it. And our I tilde is the rate on the initial margin received. On the initial margin received. So let's look at the equation. Yeah, don't get intimidated by this. There are three things, right? One is the variation margin that you have. On that, there is a spread component, which is this. That reflects the amount you earn and the amount, the borrowing cost. That differential goes here. Then you have the initial margin posted. When you post the initial margin, obviously you would have borrowed that at some rate, and then you have posting it, so you'll get some remuneration back. So that's the spread between those two is captured here. Spread on the earning rate and the borrowing rate for the initial margin that you posted. Okay. IS means it's the initial margin profile over the entire life of the instrument. That is also dynamic. This will be calculated based on ISDA sim model. Okay, you can, in Monte Carlo, you can calculate everything once you have the volatility and value of the derivative. Sensitivities also you can calculate in real time in the Monte Carlo regime. and calculate the initial margin profile that will be maintained throughout the life of the instrument. Take that and do discounting and do everything. The last one is the initial margin received. There is no spread here. This is the rate that you have to pay to the counterparty, because you got the collateral. On the collateral, you have to pay the remuneration to the counterparty, correct? There is no spread here. You know why? In both of these, there is spread. Here, there is no spread. It is the raw interest rate that you have to pay to the counterparty on the initial margin received. This is just an outflow, pure outflow. There is no earning or remuneration or anything. Think about this. Take 30 seconds and tell me why there is no spread on the last component. Exactly, because the initial margin that you receive, that is not rehypothecable. You cannot earn anything out of that. That will remain in a vault, safety deposit, right? You cannot use it. So you just have to pay the interest rate to the counterparty. If this was rehypothecable, then you would have, hypothecated in somewhere else and earned some remuneration. So then there would have been some spread. But this is locked, so you cannot use it. Okay, so that's why there is just a raw return on this. So this is at a high level what colVA is. Now, after colVA, there is a specific term, which is the middle one, that is called MVA. Because this one specifically, so see, the first one is the variation margin held. Last one is initial margin held. This is the initial margin posted by you, right? That is called as MVA, margin valuation adjustment. Okay, so it is calculated separately as MVA. So colVA now has these two terms, first one and second term. The middle one is captured as part of MVA. All right. Now, as you can guess, this calculation is extremely complicated because you have to calculate the initial margin profile over the life of the instrument and take the discounted expectation, etc., etc. It is closely tied to the ISDA-SIM model. Okay. Now, finally, we have KVA. KVA stands for Capital Valuation Adjustment. If you look at this description, it should have been CVA, but CVA is already taken. So probably the, KVA makes sense, right? KVA is for Capital Valuation Adjustment, and the principle or the inspiration is similar to RAROC. Obviously, it makes sense because, see, when you enter into a derivative contract, it's a risky asset, and regulators say whenever you have a risky asset in your book, you have to keep capital, right? That is the risk capital. Now, for every derivative, depending on the kind of derivative, you have to keep risk capital for that. We'll see what are the different types of risk capital that gets associated with the derivative. Now, when you keep the risk capital allocated for that derivative, you cannot use that capital for your business purpose. That you have to keep as buffer, right? On that capital, you are supposed to provide return to shareholders. You are answerable to your shareholders. You are supposed to generate a certain amount of return. We call it as a hurdle rate, or even weighted average cost of capital, WACC, which is a blend of equity and debt to reflect your total borrowing cost, not borrowing cost, total cost of capital. So on that capital that gets associated with the derivative, you are incurring cost of capital. So that's also a cost to you, right? Same idea as RAROC. RAROC is risk adjusted return on capital. Something similar we have here. For derivative, when you're entering into it, you are committing or signing up for a rate of return, which is the cost of capital, based on the risk capital that you're supposed to keep as part of the regulatory capital calculation for that derivative, and that is a cost to you. So you need to price that in as well. And this is the most complicated one because, okay, let me ask you this. What are the different types of capital charge we have for a derivative? What are the different capitalization frameworks that we have to capture the capital required for a derivative transaction in Basel? Market risk and credit risk. Is that all, or we have something else? Operational risk is not specific to a trade. I mean, it's overall. CCR is actually the part of the credit risk that is tied to the derivative. What else? FRTB is a market risk framework. Yes, there is one more. No, interest rate. Yes, there you go. CVA risk capital charge. Yes, yes. So here is the thing. Let me break it down for you. We have market risk, which is the FRTB framework, the recent one. This risk capitalizes the movement in all the risk factors that drive the price of the instrument. So if you're thinking of an option, which is a derivative, then the market risk for that option will be changes in, let's say, equity spot, right? So that is delta risk. Then we have vega risk. Then we have gamma or curvature, rho, theta, whatever, right? So those are all part of market risk capital charge, right? Second, CCR, counterparty default risk. Default risk, this is part of the credit risk, which capitalizes the default risk of the counterparty. What if the counterparty doesn't give you the money that he owes? That's a different risk. It's not driven by market risk factors, although in the formulation of the default risk of the counterparty, we'll use the same PD times LGD times EAD that we use in credit risk as well. PD and LGD will be similar to your IRB implementation. Or if you're using standardized approach, use the same standardized approach for PD LGD. The tricky part is the EAD part. EAD in case of a derivative is taken as an expectation because the exposure is bidirectional, it is stochastic. So we take an expectation, right? So that's part of the, so we have two ways to calculate EAD for a derivative. One is called SSCCR, which is the standardized approach. Then we have an advanced approach called as IMM, internal models approach. So both of these we'll discuss in the upcoming classes in the course. So that is CCR, okay? And then we have a standalone CVA capital charge. The only xVA that regulators identified as something that you need to capitalize is CVA. They have expressly told, do not consider your own default risk. So it's just from a regulatory capital perspective, the only xVA that you have to worry about is CVA. So your valuation of a derivative is risk-free valuation minus CVA. Since you have an additional component CVA, there is variation in CVA as well. So, right, so since it entered into the pricing function, you have to capture the variation of the price to capitalize it. So since CVA is a component, the variation in CVA becomes a capital charge. And its CVA variation comes from two aspects, the exposure as well as credit spread of the counterparty. So that's CVA capital charge. So the moment you have a derivative, you need to calculate all these capital charges, add them up. That's the total capital, regulatory capital you're signing up for as part of KVA, right? And that becomes your capital profile over the life of the instrument. You have to calculate that. This is so much involved, okay? So let's look at the expression. This is golden. This part is golden because both you and the counterparty have to survive, joint survival probability. capital profile of the derivative by combining all these three capitals at every time point in the entire over the life of the instrument. This is so much involved, right? And then the rate that you incur is the cost of capital. This would be subjective, depends on the bank's capital cost, typically 8%, 10%, but this could be subjective. Okay, cost of capital, and here we have regulatory capital profile. All right, so that's yeah, it was a very quick overview of all the valuation adjustments we have. Over the course of time, we'll cover all of these individually, one by one. If you are interested in enrolling in the course. All right, so let's do a quick Python implementation of a very simple use case, and then we'll call it a day. Part 2 is Python implementation. So here are the steps. Step number 1, identify the stochastic processes that you need to model your risk factors, right? Calibrate the parameters of the stochastic process based on no arbitrage strategy. So let's say you have a term structure model for interest rates. Maybe you are using I don't know, Holy model or Hull White model. So those have drift and volatility parameters. You have to calibrate those parameters in such a way that the model prices match the market prices of liquid instruments. So that's part of calibration. We're not going to do that. It's a whole new chapter. Once you have calibrated parameters, you do Monte Carlo simulation. Right? In the Monte Carlo simulation, you are able to model the underlying risk factors, and using a suitable pricing function, you need to simulate the value of the trade at all points in time in future. It's random, but you need to simulate the value of the trade. What are the value of the derivative that can be in the at different points in future? Now, and in this part, we use typically they use analytical or semi-analytical formulas for pricing, because already you are within the Monte Carlo routine. Okay, within the Monte Carlo, if you have a Monte Carlo pricing scheme, then it will be a Monte Carlo within Monte Carlo. Nobody wants that. So people use pricing functions that are fast, which are analytical or semi-analytical, some kind of approximation. You cannot use Monte Carlo within another Monte Carlo. That will take forever. And then you calculate exposure metrics. So exposure metrics, as we discussed, right? PFE, all those things you calculate. And then do a discrete implementation of xVA. If there are collateral, that needs to be modeled along with the exposure based on the equation that I showed you. And then you calculate residual exposure if needed, and then create a profile, take average, find PFE, do whatever you want, then calculate the xVA. So that's the flowchart. Okay, so let's look at a quick Python implementation. Right, so here we're going to do a very, very simple thing. Otherwise, it will be very complicated. We'll take a simple case of plain vanilla IRS, right? No collateral, nothing. But this will give you a very good idea of how to go about calculating the exposure metrics of an IRS, and we'll calculate CVA, DVA, and FVA, right? Other things obviously are much, much more involved. So we'll do that later. Yeah, so that's the agenda. So let's get started. If you don't know Python at all, don't worry about it. Just get the feel of what are the things we are doing. Right, so importing standard libraries, this NumPy, Pandas, and Matplotlib for plotting. Let me import that. All right, I'm going to use a VASI-check model to simulate the short rates. This is the mean reverting dynamics of short rate. Assuming that these are all calibrated, actually we don't use VASI-check model in this fashion to calibrate. You will never be able to match all the instrument prices with only 3 parameters. So we use some kind of no arbitrage model, either Holy or Hull and White. Hull and White is very, very popular. So you have a deterministic time dependence of the drift parameter. Again, keeping things very simple. So these are the parameters. This is my initial short rate 5% R0. Okay. So let me store that. I have a file where I'm keeping the current term structure. So let's read that. So this is my current term structure. This is a 10-year swap. Okay. 10-year swap with quarterly payments, fixed floating. This is my term structure. These are the discount factors for different tenors. Okay, 10 years. This is my discounting factor. Year fraction is 0.25 because it's quarterly. Now, right now, looking at the term structure, I can find out the initial swap rate. Remember the swap rate formula, which is 1 minus the last discounting factor, which is this one, divided by tau times sum of these discounting factors. Correct? So that gives me the initial swap rate. So if I enter into a 10-year swap right now, this is the fixed rate that will be fixed for the life of the instrument. Unless it is resettable swap, where you have to reset the swap rate again and again. Okay, so right now the value of the swap is 0 because this is the fixed rate and this is obviously also the swap rate. So overall the value at inception is 0. Now I'm going to do Monte Carlo to simulate the short rates. Again, I'm not going through details of this. I'm fixing the random numbers. This particular code fixes the random numbers. Every time I regenerate the Monte Carlo scheme, it will generate the same set of random numbers. This is to have reproducibility basically. Otherwise, every time my answer will be different. Okay, the one thing that you have to note here is this is where I'm plugging in the Vasicek model. Okay, next step R is previous step R plus K times theta minus R dt plus sigma. This is Z that I randomly simulated using NumPy square root of dt. So I created a function that will generate this simulated short rate. Now for the swap parameter, this is the notional and this total time tenor is 10 years. Simulation parameters, I have 10,000 simulation steps, simulations, and number of steps is 40 because this is in time dimension. Okay, because every quarter is one time step. So for 10 years, I have 40 time steps. Let me run this one, this one. Now I'm just calling the function that I just defined using these parameters, and I'm creating a data frame to store the simulated values of the short rates. So here I have 10,000 simulations. At time t equals 0, the initial short rate is always 5%. And from there, it takes various paths. This is one path. This is another path. Different paths, 10,000 simulations. Okay. Till the, 40. Okay. Now, let's plot that. Plotting is always nice. Okay. So this is how it looks. So far, I have simulated the short rates, which is the risk factor. Okay. Next step would be to price my IRS. Price my IRS, right? Please note one thing. So here, if I want to show you, at time t equal to 0, if I'm standing here, right, the price of the swap is 0. At time step 1, my short rate could be anything, any one of the 10,000 values. There are a few things. Now, let's say you are on this path, okay? This is my new short rate, which is prevailing at time 0.25. That's the first quarter. At the end of that, this is my new short rate. Now, given the new initial short rate, okay, Vasicek model gives me a closed form valuation formula for discount factors or zero coupon bonds. Zero coupon bonds price is same as the discount factor if the principal that it pays at maturity is $1, right? Vasicek model has closed form analytical bond pricing equation And that will give me, if I stand here and this is my initial short rate, what would be the term structure or discount rates? They are interchangeable. That I can find out using closed form solution. So let's look at that. So see, this is the set of calculations. Okay, price of the zero coupon bond for any maturity capital T standing at time small t is A e to the power minus RB, where A is given by this big expression. Everything is deterministic here. There is nothing, I mean, you know where you're standing and for which maturity you're trying to calculate the discounting factor, right? That's small t and capital T. Just plug in here and these parameters are constant. So plug in everything. You get A, you get B, put it here, you get the discounting factors standing at small t for various maturities. Okay, I need those discounting factors because I need to do the same thing again. So this is the initial discounting curve at time t equals 0, right? I will always come up with a new term structure or simulate a new term structure standing at different time points. And standing there, based on the new discounting curve that I have, what would be my new swap rate? Okay. So indirectly, I'm simulating swap. I'm going there. I need to calculate the new swap rate. Okay. So once I get the new swap rate, that new swap rate minus the fixed rate that I have times the year fraction and everything times notional, discount all the cash flows to where you're standing, that will give you the value of the swap. It is random because in every path, I have a different initial rate. This will give me a different term structure. Different term structure. Under each of those different term structures, new discounting factors, new swap rate minus the fixed swap rate times notional times year fraction, and discount all the quarterly cash flows to wherever you are standing. That will give me the price of the IRS for each of these points, grid points. Okay, we'll do the same exercise standing here. If this is my initial short rate at time t equal to 2, what is my new term structure, new discounting factors, the same story all over again. Right? So at every time point, I have to build the whole term structure, taking this as the initial rate and redo the whole exercise. So it's a lot of calculation, okay? Now, in NumPy and Pandas, everything is vectorized, so the whole thing is very fast, right? So let me not go through these in detail. Yeah, it'll take a lot of time, but yeah, I'm defining a simple discounting function, which is basically, it takes the initial short rate, where you're standing, what is the tenor for which you're trying to calculate the discounting factor, K, theta, sigma, are the parameters. Calculate B, calculate A, calculate P, and return P. P is my discounting factor, right? So let me run this. And here is a simple, just testing that it is working or not. Initial short rate is 5%, standing at time t equal to 0. 0.5 is my tenor for which I want to find out the discounting factor. Pass K, theta, sigma, and I'm getting this discounting factor. So this is a scalar implementation, but the same thing I need to do a vector implementation. Now, let me not go through this. Basically, whatever I explained, that is the thing that I'm doing right now, right? Calculating the discounting factors. Swap rates, if you see, swap rate has the same formula, 1 minus last discounting factor divided by tau times sum of discounting factors. This is the new set of swap rates standing at a particular time. Exposure is notional times year fraction times simulated swap rate minus fixed rate, correct? Discount everything to the wherever you're standing. Okay, so finally I have the swap rate simulated, and then the V is my exposure. Let's see. This is so fast, right? There are a lot of calculations going in. There are 2 for loops, and yeah, Anyways, so what I have here is at time t equals 0, the value of the trade is 0, because my swap rate that I calculated the swap rate as the fixed rate. So anyways, it's 0. And here are the future exposure values. Standing at time t equal to 1, the value of the IRS could be positive, negative, right? Standing at time t equal to 2, the value of the swap. Finally, when you reach the maturity, it has to be 0 because there are no cash flows remaining, right? Okay, so this is the heavy lifting part. And then everything else is pretty much very easy. See the elegance of these calculations. It's very easy because Python, in NumPy, everything is vectorized. What is the expected future value? It is simply the mean of V. Axis 0 means along this axis. Axis 1 means along this axis. So we are calculating the averages along the various paths, right? Taking all the paths together, standing at a particular time point. So that's why this is all axis 0. Expected future value is mean of V. V plus positive exposure. So if somebody asked, right, do we ignore the negative values? No, we take V or 0, whichever is maximum. So if it is negative, it will pick 0. If it is positive, it will pick the V, whatever it is. So just to give an example, this value would be replaced by 0. This we will keep it as is, as is, as is. This will be 0, and then take the average. That's V plus. This is V minus is the minimum of V and 0, right? Expected exposure is mean of V plus. Expected negative exposure is mean of V minus. And then for PFE, I'm taking 95% quantile of the V, the exposure, along axis 0, right? So let me calculate these. Let's do the graph. This is the most satisfying curve in all of counterparty credit risk, because I could have taken an option, equity option, using Black-Scholes. Calculation would have been very, very straightforward, but you get a boring profile like this. For forwards, for options, linear instruments, it all increases monotonically. For IRS, we have a very interesting profile. It actually grows and then it peaks here, and then it goes down. So you see four different things. Expected future value is close to 0, because at the inception it was 0, and it stays as 0. It's the mean of the exposure. This is the EE profile. This is the ENE profile. And this is the PFE profile. Okay, and I'm pretty sure you must have seen this graph everywhere. All right, so yeah, once we get the exposure metrics, then we can keep rolling. So the next set of calculations. Any questions, by the way? Any questions so far? There are a lot of different exercises. How does it look in the presence of collateral? What if you have two trades? Then you have to do netting? I mean, all of these we will do slowly and steadily. Okay, next set of calculations. So it's all about the PD term structure of counterparty and yourself, because you also are defaultable, right? So here is the recovery rate of the bank, here recovery rate of the counterparty. I have a file from which I will read the CDS spread in basis points for the next 10 years. This is my CDS spread in basis points for B and for C. B is bank, C is the counterparty. Yeah, so I'm calculating the survival probability. Remember, survival probability is e to the power minus lambda times t, and lambda is your spread divided by LGD. That's all. Right? Survival probabilities. Then you calculate the marginal probabilities. For the first one, it will be 1 minus e to the minus lambda t. But for all the other ones, it will be the difference of the survival probabilities, right? You calculate at the left end and the right end, take the difference, that the marginal default probability. Okay. And yeah, I'm enhancing that data frame with EE, ENE, and discounting factors that I just calculated. Right. So ultimately, I want this kind of a data. So it's easy to visualize, right? So for different times, these are the CDS spread that I had. I got the survival probabilities extracted from the spread, marginal probabilities of B and C. EE and ENE I already calculated before. So I'm reusing that. And this is the discounting factor standing today. Very important. This is current term structure. It's not simulated one. Okay. Question from Rahul, from model implementation perspective, which is mostly used, discrete or continuous equation? No, so you always actually start with continuous because it's elegant. And if you are using continuous maths, you can use calculus, right? So that's the hallmark. But once you frame it in continuous, then you discrete. The implementation is always discretized. You have to do a daily simulation or weekly simulation or monthly simulation. Develop all your maths using continuous arithmetic. You can use calculus, derivative integration, that only applies for continuous domain. Once you formulate, you discretize it. There will be some discretization error, and right, and numerical approximation, all those things. Implementation is always discrete. All right. So let me give an example. Can you give me an example? You know this. Give me an example of a discrete formula and discrete implementation. Here, what we did is continuous formulation, but discrete adoption, right? Can you think of a formulation which is discrete in itself, and then we implement it as is? Anything that you can think of? Bond pricing, Euler-Maruyama is a discretization scheme of a continuous model. It is not actually a discrete model. I'm asking a discrete model. All of you have studied this, 100%. In fact, it is something that we study when we when we read options for the first. Exactly. Binomial binomial option pricing. You can also do bond pricing as well, but that is a pure discrete model, right? You model up, down. Sometimes you use trinomial, but that is a proper discrete model. There is no integration derivative there. Okay. All right, good. So we have this data frame. Now we have everything that we need to calculate. So what is UCVA? UCVA is this stuff, right? I actually cheated a little bit. I did not use this formulation. I simply took, so for UCVA, right? 1 minus RC times EE times discounting factor times the marginal probability of default for counterparty. So it's simple sum product, just 3 columns. This column, sorry, this column, this column, this column, and 1 minus RC. Ideally, you should take this times this plus this times this average, then multiply with the PDC. But I got a little bit lazy, right? So this is plain vanilla implementation of UCVA 1988. For BCVA, you have to be very careful whose recovery you are taking, and whether it's EE or ENE, whose survival probability you're taking, and whose default marginal probability default you're taking. Just have to be careful with those. Formula is straightforward. 211. Okay. And finally, I have FCA. I didn't take FBA because FBA replicates DVA, which is this part. For FCA, it's actually the same thing. The last part, only thing is instead of ENE, you need to do EE because this is plus. Remember, cost is associated with an asset when you have positive exposure, right? There is no collateral, so this is just B plus, which is EE. So that's FCA. That's all. So my intent was not to obviously cover everything. That will take a week, not can never be covered in a matter of 2 hours. So this was just to give you an overview of what all modeling aspects we have at a high level, and then this is something we'll be covering one by one, slowly and steadily, in the upcoming classes of CCR. That's actually all I had. Any outstanding questions, feedback, comments? If you have any further question in terms of logistics or the course, you can reach out to us. Let me write down the Karan Agarwal, so you can reach out to him, or you can reach out to me. Let me leave my email ID. There is. Okay, let me stop the recording.